Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
Tuesday, May 25th, 2010, the MTA Podcast Series. Markets are self-defeating rather than self-correcting. The U.S. has been in a secular downtrend since 2000. It is likely that it will remain in this trend for another 10 years. This isn't going to signal a crash or anything like that, but I think it will signal a significant dip to an important buying low in October. An initial fall between 8 and 10%, then a rally, a midsummer rally, let's say 3 to 5%, and then the rest of the fall. The total fall to October, the October low, should be in the range of 10 to 15%, and then I think it will come back again in the last part of the year. My forecast is the American market will make a top on Monday, the 19th of April at 3:30 in the afternoon. Today's guest is Robin Griffiths. Robin Griffiths joined Cazenove Capital in 2008 as technical strategist, providing strategic input and marketing support primarily to private wealth management. For over 30 years, Robin Griffiths has been one of the most respected technical analysts of world stock markets, bonds, currencies, and commodities. He became a technical analyst with W.I. Carr, first based in Hong Kong and then Tokyo before returning to London. During this time, he started to develop his own trading system, analyzing stock and market trends. He was then chief technical strategist with HSBC for over 20 years. His most recent position was as head of asset allocation with Rathbones. Robin was chairman and now a fellow of the STA, the British Society of Technical Analysts. He was also chairman of the IFTA for 3 years. He has written several books, including Mapping the Markets and Future Storm. Robin Griffiths, welcome to the program.
Thank you.
Yes. Well, it's been great having you with us today, but I'm afraid we're out of time. Maybe you come back in someday. No, that's quite a work history you've got, and I can't wait to dig into some of this. But we normally start with a little personal background in these interviews, and maybe you can fill in some blanks, such as where you went to school, what did you study, and how did you get from there into technical analysis?
Okay, well, it does go way back. I was at school in Bedford School in England, and when I left there, I didn't want to waste time going to university because I'd watched my own elder brother do exactly that, and he got seriously bored. So I actually went into an engineering company called Lucas. That made components that go on cars, and there I learned mechanical engineering.
Really?
And when you're running a lathe or a milling machine, you don't measure every single component. You measure 1 in 1,000, and you monitor them within tolerance limits. So we were effectively doing regression analysis.
Right.
Anyway, once I'd qualified as a mechanical engineer, I realized, you know what, I do want to go to university. And then I switched to reading economics. And I had statistics as one of the subsidiaries, and that's again where regression analysis cropped up.
Of course.
So with my degree in economics, I joined Phillips and Drew back in 1966, and naturally started to plot share price movements and use regression analysis on the charts. And back then, this is before Bollinger Bands and all of that, I suddenly was phoned up by one of the doyens of technical analysis in England and told that I'd invented a new technique, because most chartists, they call themselves over here, used to put a ruler along all the highs or all the lows, and I'd seemed to have got a computer that calculated lines kind of either side of the middle. They thought that was a really neat idea. So that's what got me into it. And then particularly David Fuller, who was then talking from his own company, Chart Analysis. I would meet him and talk about it with him, and he encouraged me. So that was really my start. But because I have a degree in economics, I've always tried to use the cycle theories of Mr. Schumpeter, Joseph Schumpeter, and say if those are right in the real world, this is what it's going to look like on a chart. And I pretty soon came up with some wave patterns. But back in the early 60s, I met a man called Robert Prechter. And I decided he was a really good guy, and I liked him, but I was obviously going to have to disagree with him many times in my career. So however he lettered his waves, I was going to letter mine differently. So many people will recognize my roadmaps as being basically an Elliott wave type shape. But as I letter mine differently, I don't need to keep worrying about what the Elliott Wave guys will be saying, and I don't take some of the positions that they do. My Elliott Waves work on a big scale, basically. He would call them supercycle scale. I don't follow them down to the sub-minuet level at all. So
well,
that's what got me.
Whatever it is you're doing, you seem to be doing a heck of a good job. I mean, all jokes aside, about 3:30 in the afternoon, you called the top of the market within about 5 days, if I remember correctly.
Yes, that's true.
Why don't you? Usually we don't get to this until a little later in the program, but let's go ahead and jump into a portion of our interview we refer to as the toolbox. That is, let's talk about some of the tools that you use, and how did you use those tools to come up with this forecast where you called the April, 26th market top?
Yes. And the date for the UK market, it was actually Friday the 16th. But as you say, it was the 26th on the US. So my date, the 19th, was in the middle there.
Okay.
Basically, what I was looking for was exhaustion on the rise that had taken place from March 2008 onwards. And I got a Bloomberg machine, and with the Mark 13s, like confetti at a wedding, there were plenty of them around. The number of stocks above overbought in levels, and even just the number of commentators who were now bullish. All of those things looked to me like as good as it can get. It was exhaustion. And in any event, my own roadmap has always described the entire rally from March 2008 up as a rally in a secular downtrend, in which case it wasn't allowed, Fibonacci-wise, to retrace much more of what it had lost since the year 2000, basically.
It was up, 61.8?
Yeah, all of that, yeah.
Right.
And then furthermore, there's most Western markets, all mature Western markets are on the same basic roadmap shape, and they don't all roll at exactly the same time. So I was getting these exhaustions in lots and lots of indices. I actually follow 40 different world market indices. So the one was confirming the other, and it was just a question of, well, it's soon, it's about now. Actually, the 19th looks like it will just about crack it. And it was far from a consensus call at the time, but I think it was exhaustion and an overbought condition is what I was looking at.
Mm-hmm. You know what? There were two of the quotes that I read in the opening I want to review, but you just segued into one of them perfectly. I'll repeat it. The U.S. has been in a secular downtrend since 2000. It is likely it will remain in this trend for another 10 years. Why don't you give us some insight into where that comment came from?
Okay. Basically, the driver of the economic cycles comes from Schumpeter's model, in which there are three basic cycles. The very, very long-term cycle, which I call secular trends, he called the Kondratiev wave. And these tend to go up and down for lengths of time, like 20 years at a time. And then around that, the other two cycles are the 10-year cycle, which I call the juggler cycle, and the 4-year cycle, which these days we use the presidential election cycle, but back in Schumpeter's days it was called the kitchen wave. And when it was a British cycle, it averaged about 3.3 years, and roughly 3 kitchen waves made up one juggler wave. But ever since the U.S. has become the dominant economy, although the kitchen wave is not the same thing as the presidential election cycle, the presidential cycle has tended to sort of dominate and drown out the kitchen cycle. So I've been putting a 4-year, a 10-year, and a longer-term cycles together. And this is what generates my roadmaps, basically.
Mm-hmm. You know, you said, go ahead.
Yeah, well, not in the Western markets, not only has the secular trend been negative since the year 2000, but in terms of where we are in the 10-year cycle, we're in the negative part of the 10-year cycle. V low is never in the 8th or 9th year of the decade. It's always in the 0 to 02 part of the decade. And then the same with the presidential election cycle. We're in the weak part of the 4-year cycle. It's not until the off-election year that you get an important low. We're in the negative part of the 4-year cycle as well. So the only thing holding the market up was the annual seasonality which all markets have. And that normally we say sell in May and go away. And then we come down to a low in October. All I recognized in April was this rise can't possibly last until May. It's getting exhausted right now in April. So that was why I just brought the May target forward a little bit, basically.
Mm-hmm. Mm-hmm. Okay, so we've talked about these cycles, Schumpeter, a little bit of Elliott wave. Are there any other tools that you haven't mentioned? Gann's, astronomy, anything else you'd like to share?
I've got photocopies of the original works of Gann, and I do spend a certain amount of time with that. Many years ago, we actually used to publish Gann lines. And I actually had an assistant then who had a specialist computer that had the Gann lines on it. But I don't publish them now because the clients back then said, Robin, you look at all these magic lines. You just tell us it's a buy or a sell. We don't want to see all this stuff. Mm-hmm. So but I do believe that Gann had some good theories which add something and are right. And one of which is anniversaries of highs and lows are themselves highs and lows. And these sorts of things, and speed lines, and when you break the speed line, you're going to go down to the lower speed line. Those sorts of things I do use. I think they work, basically.
You say you have copies of the original works of Gann. Where can one get that? Where can the rest of us find that?
I think some of them may well be in the are in the library of the British Society of Technical Analysts, and the MTA library may well have them. I was very lucky that a man now dead brought his books in one at a time, and allowed me to photograph them. And when I'd done one, he'd bring me in the next one. And so I got them from a man who was a British guy called Bernard Jones, who's sadly now no longer with us.
Yes. We're going to continue with Robin Griffiths in a moment, but first a reminder that on June 8th, we'll have Doug Roberts of Channel Capital Research. Robin, you mentioned just a moment ago something about the U.S. becoming the dominant economy. However, when I read your research, correct me if I'm wrong, you believe that China is now the dominant world market. Talk to us a little bit about that.
Okay. I mean, using what are these days the consensus forecasts, which probably came from Jim O'Neill, head of research at Goldman Sachs, from his BRIC report. After all of the growth that China has produced to date, it is still only 1/4 the size of the U.S. economy. But on its current trends, it's due to become actually the number one economy in about 17 more years. And India is due to overtake it in another 10 years after that. So that's my probably the consensus view of the fundamentals. However, in many individual industries, China's already got there. And particularly in the motor car industry, I think roughly the U.S. car market's 10 million cars a year. The China car market's 13 million cars a year. It's already number one there. And in terms of timing on the stock markets, they already are. It's the lead market. And if you look at the chart of the Shanghai Composite, most people don't realize it peaked 2 years ago, is down 60%, and is falling like a stone now. So it was pointing all along, saying this is where you Western markets are going to be going. And, it was saying that well before April. So my lead indicator was resolutely pointing down quite early on.
Mm-hmm. Let's touch on that other quote in our opening. What does this mean? Markets are self-defeating rather than self-correcting.
Yes. George Soros has written up this in his book on reflexivity. If you leave free markets alone and unregulated, they don't tend to be naturally self-correcting and mean reverting. They tend to run away in exponential up or exponential down moves. And they've proved that time and time again. So we do need circuit breakers and we do need regulation because in the short term, free markets establish the price of things very, very well, very efficiently. But what they don't have is any moral or value judgment. And because algorithms, anything with a feedback loop has the ability to go exponential and feed back on itself. And when we had that period when the Dow crashed almost 10% in minutes, that was algorithms chasing it. And that more or less proving the wisdom of George Soros's observation there, basically.
Let's shift gears here a little bit and talk about your typical day. Tell us, how does your day go? What do you do?
I come in pretty early in the morning, and I log on my Bloomberg machine, and I spend hours and hours and hours reading emails and going through charts. I mean, most of the emails that come to me are jolly useful stuff. I'm glad I read it, and I do deliberately read people who I know I'm not going to agree with. I mean, I read a bunch of economic forecasts, not just Rubini and Schiller, but a whole bunch of British ones as well. And I also read Martin Barnes of the Bank Credit Analyst, mainly because I want to get a feeling for the highs and lows of what is out there in the market of good people trying to do their best to forecast it. And I also deliberately read some technical people, and Richard Russell, of course, for years, and the deliberations, and a whole bunch of other good technical work. Because again, I want to see what is being thought about in there. But when I do my own work, my roadmaps, my moving averages, my regression lines, and I do look at RSIs and those other indicators, but they're not dominant in my thought process. It's the roadmap, the economic cycles driving the roadmap shape that I'm expecting to develop. So I'm not guessing where it's going. I've got a sort of roadmap in mind with even timings on it coming from the economics around which I expect the real world to sort of unfold. Even if it doesn't fit perfectly, it ought to be guided by my roadmap anyway.
Mm-hmm. So you come in early, you plow through all these emails and research, and then is it lunchtime before you start working on your own work?
Lunchtime is my main meal of the day. I'm of the old school. When I first became a stockbroker back in the 60s, if you didn't eat a proper lunch, its only reason was you didn't have any clients and you weren't doing any business. And you were definitely allowed wine at lunch. So, and all of this, a quick sandwich and a Coca-Cola at my desk is not for me. I'm British. We don't do that sort of thing. But then I have very small breakfast and almost no dinner, so lunch is a proper meal. That's why when I call for these highs and lows, it's always after lunch. And I quite frequently stay till about 8 o'clock at night, because when it gets quiet, I do some of my best work there, basically.
Really?
I can hear myself think in the evening. Yeah.
Yes. So then you have to put all this into some sort of research report. Talk to us about how you communicate with the consumers of your research.
Okay. I do actually write a newsletter. For many, many years at HSBC, I wrote a 50-page report, and that they sent it out as a research product to many institutions all over the world. Since I hit their compulsory retirement age, I've written a similar report, which goes to, some institutions who want to buy it, but the private clients as well. And that equivalent report is now published by Investment Research of Cambridge. The owner of that company is a woman called Deborah Owen, and she and I co-authored the book called Mapping the Markets. So it was always the name of my presentations at HSBC, but I mean, it's all officially regulated by the FSA. That's why I publish it with them. Internally, for the Cazenove clients, I attend meetings and meet the clients and just talk to them direct.
Mm-hmm. Mm-hmm. We're down to our last 3 minutes here, but this one book I mentioned, Future Storm, that's interesting, or at least an interesting title. Did it talk about what we're going through now? And if so, when did you print it?
In Future Storm, we identified 6 dynamics of issues that we thought would be very important. One of them was the lack of clean, healthy, fresh water. So there was a big theme globally about water. Mm-hmm. Another one was religious fanaticism, not necessarily Muslim fanaticism, but, what with 9/11 and all of that, it seems to have been a big issue. And another one was very much the growth of India and China, and how the world the pendulum is swinging from the West towards the East, and their cultural things, these sorts of things, was what the book about. And we followed it up with a book called Water, the Ultimate Resource, which, because that particular element seemed to be very, very topical, and, many people have set up funds trying to invest in water.
Yes.
And, the planet's covered in water, but there's not enough of it in the right place. And so we've got to desalinate the sea. There are all sorts of ways in which we're going to investing in water is not going to be a boring theme, but a very dynamic growth market, I think.
Robin Griffiths, is asset allocation dead?
Well, in a sense that diversification was proved not to have worked, because when you enter a proper bear market, everything fell together. So you could argue that in the bear market to March 2008, it didn't work. But I think it's not dead forever. And I'm encouraging people to put more of their money in long term into markets like India and Brazil, and also into markets based on resources like Australia, Canada, and South Africa, rather than just stay in what they feel comfortable with, which is their own home market, because the home markets are a bit mature and overdeveloped and are needing new inventions to come along to get them to go again. And so I believe in asset allocation, but as it was traditionally practiced, it's certainly had a rough ride recently. I accept that.
Yes. Robin, it's late in London. We really appreciate you taking the time today to stay around and talk to us. Before we go, is there anything else you'd like to mention?
Gold. Gold is real money. I mean, I'm not a gold bug, but many central banks are printing paper money with abandon. Anything you throw out of a helicopter window is going to eventually go down, and you will need to hedge that. So I think in the immediate panic, which we're clearly getting in markets, gold will probably fall as well, because when people need money, they sell whatever they can. But once that dust settles, the printing of fiat money is dangerous, and you should consider gold to actually be money and an asset class to include into your proper portfolio. It certainly, in terms of asset allocation, is an asset class I would recommend to people. And I don't always talk like that. I'm not an unreconstructed gold bug by any means, but it is for now something to own.
Yes, gold and guns.
Yeah.
Robin, thank you very much. That wraps up today's MTA podcast. From Seattle, I'm Ed Carlson with Shane Squark, who, with the DOS version 3.0 dancers, is somewhere in a recording studio deep in the bowels of the MTA's World Domination headquarters in New York City. Say goodbye, Shane.
Goodbye, Shane.
Let's keep our stops tight. Good day.